A very good afternoon, everyone. Start of the year tends to be eventful, and the past week was rightfully so. We had the budget, which was not so eventful though. We had two much awaited trade deals, and obviously the turn in gold and silver prices. And today morning, we had the policy. This edition of Netra dwells on surface of what's currently happening, but primarily an assessment of where we are, with no prediction of where that can take us. This edition of Netra, the February edition of Netra, covers this across four segments. First is the India's valuation. Second, the unsettling calm. Third, identifying pockets of opportunities, that is across sectors, across industries, and across asset classes. And finally, the section on what to think when you think about gold and silver, a more fundamental understanding of what's really happening here. So, to cover all of this, I will invite Sahil to take over. So, just as a note, during the course of the presentation, you guys can post in your questions in the question answer tab. We will take them collectively towards the end. Sahil, over to you.
Thank you, Pragati, and good evening to all of you. So we will be discussing, as Pragati mentioned, the Feb version of DSP Netra, and so I will share my screen. And yes, so this time we wrote a few sections which are very important. We started off with, mentioning about the recently announced trade deal between US and India. And I think it's one of the most important changes which has occurred in the recent past. We've seen that very high tariffs which were applied on India, about 50%. They have come down to about 18%. This deal and details will become available in the times to come, maybe in the next 1 or 2 months. But first thing is that it is a step back from a very bad place that India tariffs were in. And now I think they have become much better. But we mention it here that this is a normalization, not a relief. And why do we say that? Because when we look at data from, let's say, 2023, you will realize that a lot of, for example, Indian manufacturing goods and other goods were at tariffs between 0 to 3%. So other than textiles and leather manufacturers, which were at 7% and 8%. Most other goods were at 3% tariffs. Ready-made garments were at 12% tariffs. So we were at much lower numbers. One realization globally is that, of course, we are not going to go back to 2023 levels, and there is some kind of a new normal which has come up. So maybe these 18% tariffs could continue to stay. But one important point is that look at the level of tariffs for India's competition in the exports market. They are also at very similar levels, between 18 to 20%. So if you go back to 2023, and if you look at it today, and if you assess the competitiveness that Indian exporters can have, so we have competitiveness in pockets, but because now the tariffs are on even keel, this tariff deal doesn't tantamount to, let's say, a new beginning or something which has changed positively. Of course, it's a step back from a bad place, which is a good outcome, which had a lot of pressure on India's BOP. Although it did not show up too much in numbers, we've showed that earlier also, that exports revenue actually did not take a lot of hit because of exporters being able to circumvent or find new ways to export. But in totality, we think that the competitiveness part still has to come from scale for India's exporters and ability to do value addition. Alone, tariffs at 18% will not create it. We will have to have more ammunition, more better outcomes for India's exporters for this to become positive. But yes, nonetheless, one thing has happened is that ultra high tariffs of 50%, which were obnoxious, in some sense, market never believed that they will stay. There was a general consensus that eventually US will back down, and they did back down to a certain extent. And these rates are much better than what they were earlier. Second piece also, there is this point of India agreeing to $500 billion in purchases. India's imports from US are about 45 billion or so. So maybe if it is over a 10-year period, it will not mean much. We don't know what those deal details are. Once we know it, then we'll come to know. Second is that India will have no harm in agreeing to some of these numbers because US will have a change of administration in the next 2.5 to 3 years. So, anyways, most of these numbers will not stick, right? So, what are the details of these deals? We'll come to know only in time. So, the conclusion is that it's a point where we have walked back from very high tariffs to a more normalized level. Is it a positive in itself over and above where we were in 23, 24? Currently, at this juncture, no. Maybe further improvements can happen and we improve over time, but as of now, that is not the case. So we'll now go to our first section of this report, which is on India valuations, where we are talking about from re-rating to de-rating. And here, if you look at it from a longer term perspective, we have put India valuation premium or discount over other emerging markets. If you look at the long term average, our average premium over other emerging market has been 61%. And now that number is at 53. So you could say that we have come down, but 53 again is a premium, right? We are at a premium valuation. Of course, India trades at a premium valuation versus other emerging markets because our ROEs are much more superior. But also notable is that this average itself has been skewed by 2 or 3 episodes, which is the 2004-5 rally in India and large decline in China. Similarly, in '06 and the post-COVID era. So if you remove some of these abnormality, we are more or less close to the average valuation, which we think is a good thing. So a very high premium on India was probably one of the concerns for a lot of foreign investors. Maybe that concern will reduce. If India had absolute uh, support or absolute comfort in valuations in terms of overall valuations, I think it would have been a much more better backdrop. But at least one of the parameters, which was high relative valuations versus rest of the emerging market, that seems to have come down, which is a good outcome for India from a next few years perspective. Uh, Probably also we think that there is a chance that some sort of a de-rating cycle has set in because we were already at a very high multiple, and now we have seen that earnings growth trajectory has slowed down. We will probably have now almost 1.5 years or more of single-digit PAT growth for NSE 500 collectively, if you remove one-offs and some cyclical sectors, which itself tell you that sustaining 20 times or higher rates is going to be a problem, is going to be problematic. So on the whole, I think this de-rating is good. It will probably put more opportunities on the block. And as of now, I think it will also remove some overhang from for investors' mind in terms of valuation. Second is then we look at the small and mid cap valuations in India, which were very high. And we have earlier also shown that the peak of 2007, the median valuations were 20x. In 2017, they became 29x, and this cycle they went to 46x. We had one correction in 2024-25 where valuation fell to about 33, 34 times. Right now, they are close to 36 times. The longer term average is 20. We don't know whether we go to the long term average or not. We have no clue. But it's very clear that even SMID growth of 12 to 13% in profits is not sufficient to sustain these multiples, right? These multiples will probably have to come down or roll over time. And that is probably what is happening. So we have some sort of a de-rating cycle which has set in, and we think that it can continue. And there are two forms or fashion in which it can happen, where stock prices continue to move higher and valuations don't move up. Earnings move up faster. That causes de-rating. Second is that stock prices decline while earnings continue to be strong or stable, and that is another way of de-rating. So which one will the market follow? We don't know, right? Whether it will be a price correction or a time correction, we do not know. And as of now, it does appear that in the last 6 months, but particularly in the last 1 month, some price correction has set in. And even the market breadth indicator are showing that. We will go to that in the last slide of this segment. Then we've also taken this sort of a heat map looking at where in which buckets does the market lie. So if you look at P bands for large cap and small cap, you will see that just about 24% of the market trades below 20 times multiple for large caps, and about 17% of mid and small cap trade below 20 times. Now, and if you look at, let's say, stocks trading above 30 times, you will see about 60% of SMIDs trade with multiples of more than 30 times, right? And similarly, when you look at price to book bands, one third trade at price to book of more than 6 times in small and mid cap, right? So these are sort of the full carpet of the market, which breaks down where does the majority of stocks lie, which means that it's not very easy to find bargains. But some changes have occurred with some price correction. We've seen slight movement upwards in this green area for price to book. And also you can see price to book bands in SMID, some uptick in green area, some more stocks have become better price than they were earlier. But still these numbers are too small to hunt for bargains. Usually we've seen these numbers rise to about 50% when markets are in sort of a bargain zone. But these are just ballpark numbers. They can vary widely in various market phases. The next is that there are some selective opportunities which have started coming up in high quality sector. By high quality means high ROE sectors. So we've divided here. You can see that what is the average ROE of all these sectors and what was the average ROE post GFC. You can see we've put it here. And what is the average P and what is the average P since GFC. So barring for some extraordinary items or one or two skewed numbers, for example, in FMCG, a big skew has happened after HUL's acquisition of GlaxoSmithKline. If you ignore that, FMCG is now getting closer to its average multiples, although those multiples themselves are not very low, right? Those multiples of 40 times are very high multiples. They are not low multiples, but some of the FMCG companies, I will show you in the next slide, the numbers have actually come down to fair value or in one or two cases, even below fair value. So some bargains are available. Similarly, for IT, two specific companies have come into fair value zone. Some are getting very close to that level. Same is the case with few auto components companies, some oil and gas companies similarly. And when you look at the low ROEs company, where ROEs are low, their valuation premium still continues to persist. Very high valuation premium across most companies. And this is the dichotomy in the market where you could say that inferior businesses are trading at higher multiples, while businesses which have higher ROEs or possibly are superior from a longer term perspective are facing the brunt of correction or possibly trading at lower multiple. And this is exactly where opportunities for future may lie, right? And this is the amount of price damage that we saw in the month of January. And you can see that the smaller stocks, which is colored in the pink color, you have seen the maximum fall. This is the percentage of NSE 500 stocks, percentage fall from 52-week high. So you can see that 27% of all stocks have fallen more than 30%, right? So you can say 1 in 4 stocks have fallen more than 30%, but 20% of small caps have fallen more than 30%, right? And you can see that these numbers in totality, smaller companies are the bigger, have seen bigger cuts. They have fallen much more. Larger companies have fallen much lesser. So in large cap universe, only one company has fallen more than 30%. Almost everything else has fallen lesser. In fact, there are less than 10 companies which have fallen more than 10% out of the first 100 companies. So majority of damage has occurred on the small cap, some on the mid cap. But still the valuations in small and mid cap universe before the correction was so high that it is not a sufficient crack which has occurred in the market to bring those valuations to more normalized levels. So whether it will happen or not, we have no idea, but at least this is where we stand today. The next is the asset class conundrum, and this I think is a very, very important slide which tells you that where do we stand in terms of average 5-year CAGR or median 5-year CAGR multiples, and where are the current 5-year CAGR multiples. So if you look at Nifty, we are very close to the median 5-year CAGR multiple, which is largely the large cap universe. Very similar, 55%, middling. Go to the mid cap, it goes to 76. Small cap goes to 75%. So their CAGR numbers are much higher compared to 5-year average CAGR. And also remember that even median 5-year CAGRs are slightly higher because of the way markets have performed over the last 25 years. So these 75% readings are high. Secondly, more importantly, look at gold and silver at 99.8, 99.7% of their median 5-year CAGR. Clearly tells you that they are sort of overheated. Bond market is the one where huge amount of comfort is available, whether it is a short term or long duration, where the CAGRs are very, very low compared to what they are usually. So, and then we have also shown the valuation multiples on the right on what type of valuations they are available at. One very clear indication that if you want to avoid a bad experience in the future, you should not be going to areas where the current 5-year CAGRs are very high compared to median 5-year CAGR, which is, let's say, gold and silver, right? So this is how you read this data. It tells you what to avoid, right? What will happen in the future, this data will never tell you, but at least it will tell you what to avoid and to what extent. So according to this table, the best place to be or best place to go to is the bond market. Most important place to avoid is gold and silver, and probably also some small and mid cap stocks to some extent. And maybe the middling spaces are the large caps and the larger companies in the first 100 universe. So it's a very important slide. When you have time, go and spend some time on it. It will give you some ideas. Then we go to the second section, which is a very short one, which talks about the unsettling calm. And we have written about it. This is the third time that we are writing about it. Just that we don't know when these numbers will break or when this calm will break. What does it tell you? That we have created our own definition of a bear market. You can agree or disagree with it, and you can create your own definition. One definition is market falling more than 20% and then not recovering within 1 year, which means that it gives time correction as well as price correction. So barring COVID, which did not qualify as a bear market in terms of time period because it recovered very quickly, we haven't seen a 20% decline in the market for now 10 years straight. So it is 10 years that we haven't seen that. Whenever you look at VIX, even 14 and 15 VIX is very, very hard to come by. So 1% move on the Nifty on a day-to-day basis has been very, very low. In totality, it tells you that market has been much more quieter than it is usually. And one thing is very clear that when these quiet periods break, whenever they break, the breaks are much more violent, right? Because usually the market participants aren't ready for it. So we have to, as investors, keep in mind that the amount of risk that we are running on, and it's very, very important to have proper asset allocation. Similarly, as I said, global VIX, when you look at India VIX, US VIX, European VIX, all of them are much lower than what they usually tend to be. In fact, India VIX was at one of the lowest points at the end of 25, beginning of January 26. It was within 1% of the lowest reading ever noted since the launch of VIX, which tells you that complacency is very, very high compared to what we have seen recently. The third section is on early signals, where we are noting some of the important ideas. So two of the forgotten favorites, two sectors which used to be in the limelight, which is IT and FMCG, also sometimes called the defensive sectors, they have gone out of favor. If you look at the market cap share of IT and FMCG combined, they are at one of the lowest point that we've seen. Last time we saw this type of a market share was back in the GFC global financial crisis era. We are back to that level at about 14%, which is quite low, which means that these stocks have become much under-owned. And 5-year rolling average is at about 17%, right? Which is again one of the lowest that we've ever seen. Despite their ROEs continuing to be at a healthy place, their ROEs haven't come down. They continue to be high. And that tells you that although the business is struggling in terms of top line growth and showing growth, the quality of business is maintained. and these businesses have now become highly underowned. Most so one very important point is that in India, large part of let's say FI selling has been concentrated to the large cap category, largely where FIs were highly overweight. What are these categories? Private banks, IT, and FMCG. These are and some to some extent oil and gas. These were the companies which were owned heavily by FI investors. When they sold them, these were the easiest places to get out of, and many of them have become very very underowned. For example, let's say the company like TCS, which used to have nearly 17% of FI holding, is now close to 10% of FI holding. A very large change, just in a matter of 2 to 3 years. So this is something which has made them underowned, particularly not only by foreign investors. Many of these companies are underowned even in domestic portfolios, and sentiment is also very very bad. We think that a lot of new opportunities could come in these sectors. Second is a few industry segments, as I said earlier, has started to throw opportunities. For example, general insurance companies, 5 out of 6 companies have started to trade in the lower 33rd percentile of their own valuation history, right? We haven't seen these kind of numbers in a long time. So some of these sectors have become attractive. And you can see and read, for example, IT-enabled services, 5 out of 7 companies are trading below their 33rd percentile, so 71% of the companies, right? Similarly, 7 out of 9 housing finance companies, 6 out of 14 private banks. So at least you can find some opportunities in some of these sectors to create a good, meaningful portfolio where risk reward can be favorable. Just about 1 or 2 months ago, it was hard to find even these numbers, right? Because markets had again made a lifetime high. And back in 24, I think most of these tables were empty. The valuations were so high. So markets are undergoing that corrective phase. Broadly, is it enough? Not yet, but some opportunities have started to come. That is what we put in the early signals part. Third early opportunity that we see is the bond market, where we think that duration possibly can be a attractive proposition, where we are seeing 3-4 dynamics play out. As noted earlier, our inflation continues to be at multi-decadal low. Liquidity continues to be stable. In fact, even in today's policy, RBI did not mention any significant challenges on that front. It's been in a flux, but slowly and steadily it's improving. Spread of the 10-year bond versus the repo rate is very comfortable at 140 to 150 basis points. One dislocation which occurred was slightly higher borrowing by Government of India for FY27, but we think that number is not too high. Market reacted with a 5 basis points uptick in the 10-year yield, but we think that these levels are sufficient from a risk point of view to start nibbling in or start building your exposure towards duration. So these three were the early signals. Last section is on gold and silver, which has been in a lot of debate. We put out this section. We wrote this section on 29 January, but there was a huge volatility on that night and the next day. But we sort of preserved that section. So the first 3 slides are dated 29 Jan, and maybe the prices are not there today and they could be irrelevant. But the thoughts that we wrote are not irrelevant. They could be meaningfully useful. So we look at some of them. So when we were writing on 29 Jan, gold was at 5,517, 5517. And silver it was at 117.8. After that, both of them made new lifetime highs. At that time, gold was overvalued by 21.8%. And I've explained this valuation methodology in many videos earlier, October 24 and October 25, and many other. If you go back to 22, 23, I've explained how this whole mechanism works. You can go back and refer to it. But gold was overvalued versus our theoretical framework. One point of caution: does this theoretical framework is our calculation? It may not be right. It may be right. It is not a globally followed standard benchmark, right? Which means that this is just one way to think about gold and silver valuation, and by no way that we claim that this is the right way, right? We think that it is logical, data-driven, takes into account of almost all factors which are logical. Second, silver, if you look at, was overvalued by 56%. We used a 60:1 gold silver ratio, although at that time gold silver ratio was 47, right? So now, then we said how to approach gold and silver. First thing is, let's look at silver. Silver was 56% overvalued. At that time, price was 117.8. Today, the price was $64 in the morning. So very different prices, very different outcome. You can't compare 117 to 64. But still, what is the thought process? Our thought process is that you want to be a buyer of silver on these levels which I'm marking. When gold silver ratio is 85, 100, 90, 103, right? In fact, we spoke about silver almost every time we saw these numbers, but we don't want to capture moves from, let's say, 60 to 45, right? In terms of gold and silver ratio, right? Those moves are too hard to capture, too fast. And by experience, we can tell you that most people who enter this late may see some M2M gains, but eventually they end up having losses on their positions. So it's very, very important to participate when silver is cheap, not when it is in momentum and still showing readings of gold silver ratio of 60 or 50. It's very hard to capture those readings. Second and more important point, this ratio is not set in stone, which means that maybe there will come a time when this 100 will become 200 or it will go back to 1. Right? It's possible. There is no scientific method to say that this is a sacrosanct ratio and it will never break. It will break eventually. But point is that when it comes to 100 and you are able to calculate what are the odds based on which we can take exposure, if they make sense, then that is the time to buy silver, not now, not at 45 or 50 gold to silver ratio. Second, importantly, we also wrote what do we know today. Okay, so first thing is that according to our understanding, gold has already factored in lot of or almost all of the money printing which has happened post COVID, which I showed you in the overvaluation, undervaluation. Second, central bank buying, which was a very large number from 2022 onwards, has now reduced. Central banks have started buying less of gold. I could not find any, news article or reportage in terms of reporting that this number has flipped, right? Nobody spoke about it. Although when central banks became a hot topic in mid of last year or end of 25, there was a huge amount of reporting. But now they are stepping back. We see very less mentions of it. But please remember that this rally has been driven by central bank purchases. Third point, the global consensus against USD is very, very high. But one important point to note that gold in value terms has crossed US Treasury holding as a reserve asset. Now, how much more gold will central banks buy is questionable. Why? Because when central banks, for example, let's say take the case of a hypothetical central bank. Let's say they have 50% gold and 50% in silver. I'm sorry, in US Treasury. So when they buy these two assets, and let's say the value of gold starts to decline. Let's say the gold falls by about 20%, right? In that case, the overall reserves will also fall. And when reserves fall, it will create a lot of volatility. At that time, the central banker will have to ascertain how much of gold does it want to own, right? It would always want to own lesser amount of more fluctuating asset. And I think that number has already reached that level. I will show you with data that central banks have already stepped back. And therefore, I think being negative on dollar and positive on gold, probably that ratio has flipped, right? That you favor one over the other. I think that probably is already in the price. Fourth is that there is a backdrop of low real rate and high inflation, which is supportive for gold. That is also not present today. So if you count the conditions which favor a big gold bull market, a weak dollar, low real interest rates, high inflation, none of them is present today, right? Or you could say that some geopolitical troubles are present, but they are very hard to calculate. Of course, gold has a premium because of those considerations also. But when you look at all other factors, they are not present, plus the overvaluation, which I showed you. And then gold returns in this cycle or on a 5-year CAGR basis or on a 10-year CAGR basis are also much higher than stocks. And that is the time where you should take a step back rather than step in. Therefore, we think that this is the trying to be neutral on these assets. This is where we write that at this price, it's not possible to calculate the risk reward. And therefore, you leave it to the smarter investors who can do it. You can say that we can't do it and take a step back and find other 1 feet hurdles to cross. Secondly, if you did not have gold or silver prior to 2024 in your portfolio, today is not the time to start that allocation. Maybe a time will come, or the best way to start an allocation, if you want to, if you have the urge and you can't control that urge, then go through a multi-asset framework rather than doing it on your own. Take the benefit of a multi-asset framework because the error rates are much lower, right? Because of the taxation benefits. That is the only way to do it. Or if you are, you still want to do it, then SIP is the only other route in very, very small doses. And another piece of data that gold has now the second longest streak over its 200 DMA in the last 5 decades, right? And it is still not over. It is still trading about 200-day average. Usually, these are the signs that show them that they are overstretched. We've already seen a 20% correction, right, in prices, which is usually what happens. Will this correction stretch? We don't know, right? But it's very clear that maybe these commodities spend more time, forming a base or correct more. Any sort of that thing can happen. This now is one of the most important slides, which shows that central banks, you can see, have stepped down their gold purchases. They were buying 1,000 tons. They bought 863 tons in 2025, lower than earlier. Then who bought more? Momentum chasers and speculative buys through, bars, ETFs, etc. That number has gone up. This number is now much higher than it used to be earlier. In fact, in 2025, this number amounted to 44% of overall demand. And the only time it was higher was in 2020 at about 49% and close to 40% in 2011. At that time, ETFs were not a big institution or a big tool. So this is very clear that most of the investors have jumped in after the rally. And usually we've seen, and we've repeated it many times, we repeated it for when it was happening at the time of mid and small cap stocks. We showed the same data that huge amount of inflows are happening at valuations of more than 25, 30 times, which usually doesn't have a track record of producing extraordinary returns. Same is the case for gold today, where huge amount of inflows have happened, where prices are in the overheated category, overvalued category. And if you read the first line where I write, flows follow returns, and this is once again a depiction of it happening in the real time. In the next few years, when we revisit these months, we will be able to see that how higher returns attracted more flows. And this is a clear example, a live example in a live market of that happening. And so therefore, we think that you are much better off buying precious metal when they are cheap. And the larger stable guys, the jewelry demand and central bankers are with you. They are also the buyers, incrementally adding to their purchases. That is the best backdrop for purchasing these metals, not when momentum chasers are the biggest buyers and you have very high YOY gains and you have overvaluation on theoretical models. So what you should do right now, very simply, in short, investors should wait patiently. We think that more opportunities will come, possibly, gold prices dipping back below theoretical valuation and producing a discount. That will be a good entry point. Similarly for silver, once that happens, probably we'll try to highlight. And these numbers are dynamic; they keep changing, but most likely we'll see them once again in a very comfortable environment where investors can benefit from their price trend. And please make no mistake about it. For years, we've highlighted how gold is a very, very important asset class in all portfolios, and it will continue to play that role. But all assets are cyclical, and our job is to look at data dispassionately and in an unbiased view. That is what we are doing today. For silver, we think it's a metal only useful in small doses when it is cheap at the right price. Otherwise, it can become an overbearing albatross in the portfolio. So we have to be very careful in how much and when we add, and also in very small doses. The last is the principle with which we write DSP Netra, which is margin of safety. Ben Graham said that if investing was to be distilled into just three words, it will be margin of safety. And Warren Buffett has depicted it beautifully, saying that when you build a bridge, you insist that it can carry 30,000 pounds, but you drive only 10,000 pounds. And that 20,000 pound difference between 30 and 10 is what the margin of safety is. And he says that that same principle works in investing also, which means that you want to create margin of safety in your investments, which will help you become a better investor. So with this, I think I come to the end of the presentation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.